am a fighter and not a quitter. I have been honest about the mistakes I have made. But what I don't apologise for is the fact that we have helped households through this winter, through the energy price guarantee.
2-year energy freeze, gone. Tax-free shopping, gone. Economic credibility, gone. And her supposed best friend, the former Chancellor, he's gone as well.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Trusts on the brink. The Prime Minister fires her Home Secretary just days after ousting her Chancellor as members of her Conservative Party begin to revolt. Risk evaporates. China debates a cut to quarantine rules. Stocks drop as inflation and growth risks continue to swirl. Plus, out of power, Tesla slides post-market as delivery and supply bottlenecks hit third quarter results. Elon Musk promises an epic year-end. Now, first thing is first, let's check in on the markets. And actually, there's quite a lot going on in terms of BTPs, but also yields not only in the U.S., but in the UK. Now, overall, there does seem to be a focus on the market of inflation, the fact that central banks, once again, will have to fight really hard, and that will tip the global economy into, if not a recession, a significant slowdown. So we're seeing a lot of pressure across the board. European stocks down 0.5%. Energy is one of the only industries that's really gaining in today's trading session. This is on the back of, for example, Brent 1.3% higher. Now, U.S. Treasury yields holding near recent highs. Again, policy-sensitive 2-year Treasury yield near the high since 2007. That's quite significant. And then the yen also weakening to 150. That's the first time we saw it since 1990. The European map, if we take a look at the difference between some of these countries, the UK pretty much flat, as is the CAC 40 and the FTSE MIB. Just a bit more pressure on the DAX, down 0.7%. So it's been a day and an evening of political turmoil in the UK, with Liz Truss's premiership looking close to imploding. At Prime Minister's questions, opposition Labour Party leader Keir Starmer laid out a list of government U-turns.
2-year energy freeze, gone. Tax-free shopping, gone. Economic credibility, gone. And her supposed best friend, the former Chancellor, he's gone as well.
Well, let's bring in Bloomberg's Lizzie Burden. Lizzie, when you look at, frankly, the last 48 hours, does the Prime Minister stay or go?
Well, the journalists are lining up in Downing Street waiting for the podium to arrive outside number 10. The pressure is on for Liz Truss to resign. The winds really have changed since yesterday, when it seemed that most Tory MPs thought they'd let her cling on until at least the Halloween budget. But yesterday afternoon, after Prime Minister's questions, the Prime Minister only added to Keir Starmer's list of what had gone from her premiership the Home Secretary, Suella Braverman, then for a bit the Chief Whip, Wendy Morton, though that resignation was retracted and she's actually just gone into number 10 Downing Street. Then on top of the economic strategy of Trussonomics being gone, now Truss's connection to her core really is only Brexit, but in her cabinet she's surrounded now by Remainers. Braverman's replacement is Grant Shapps. He voted Remain and he supported Rishi Sunak in the leadership election. But crucially gone, according to Tory backbench MPs, is the dignity of the party. They're embarrassed, livid by what happened over the fracking vote last night. There were allegations of manhandling of an MP to get him through the right lobby, although they have been denied by him and those involved. And there was chaos around the voting itself. So Truss is desperate. It looks like she's doomed, and we're really just waiting for who could possibly replace her.
Yeah, I mean, who could possibly replace her is the question on everyone's lips, because you need consensus if they're going to change Prime Minister. How's the market taking all of this, Lizzie?
Well, I mean, if you look at the polling, interestingly, the membership wants Boris Johnson, the population wants Rishi Sunak, but the 1922 committee of Tory benchers probably won't want to make the same mistake they've just made and put it to the membership. They may want to bypass them and just anoint a successor to Liz Truss. The markets seem to be doing OK, although the pound not so well. But that's because, as your former guest, Dean Turner from UBS, best put it, the markets are more concentrated on what the Chancellor's doing, which speaks to who's in charge of this government.
100%, certainly who's in charge of the markets. Lizzie, thank you so much. Lizzie Burden there outside number 10. Now, yesterday, Deputy Bank of England Governor John Cunliffe told the Treasury Committee in Parliament that British politicians at the top of government were the cause of market chaos.
The source, if I could put it that way, of that mini budget, and you could say of that period, I think was ministerial decisions on fiscal policy.
I mean, this, of course, means a couple of things in terms of CPI, in terms of what UK political turmoil means for the gilt market. One of our best stories today is from James Hirai saying, look, the UK's disastrous budget caused traders to flee the gilt market, and there's no sign yet that they're coming back. So let's get back to Lizzie Burden at number 10. What does this all mean for the Bank of England?
For the Bank of England, as I say, it's really all about fiscal policy at this point. But the problem is that Jeremy Hunt has taken away a lot of the sugar rush, which heightens the recession risk, which means that the BOE is going to be conscious again, despite that double-digit inflation print for September that we saw yesterday, of its own potential contribution to a UK recession. And really, the Bank of England governor, though, has made it clear that he is very much focused again on inflation fighting. There was this period of an emergency intervention, but as we've heard in recent days, they are going to get back on with active quantitative tightening, even though not at the long end, so that they can keep an eye on financial stability. But they do not want to be the government's backstop anymore.
All right, Lizzie, thank you so much. Bloomberg's Lizzie Burden there with the very latest. Now, let me just recap some of the things that we heard in terms of UK gilts. I think we have maybe a longer-term chart for gilts. It's very clear that bond futures still today show that investors are closing positions fast, trading activity low compared with normal levels, which basically means that traders that fled the gilt market, there's no sign that they're coming back just yet. Coming up, St. Louis Fed President James Bullard sees an end to aggressive rate hikes early next year. Our exclusive interview next. This is Bloomberg.
I do think they will have an impact, and in some ways have had an impact. I would cite the housing market in particular, where it appears that increase in rates has really changed the dynamics there. So that's someplace that I would say there are not long and variable lags. That market anticipated Fed moves that before they were even in train this spring. And so that's a place where we've seen impact right away. But, it's a big ship, and it takes a while to steer the ship. And so the housing market is not the whole economy. So
it certainly isn't. And it's certainly not one of the main things driving inflation now. Of course, prices have fallen. But
rents are important, though.
Well, they certainly are. Yeah. They certainly are. And in fact, that's one reason why people are so worried about inflation staying high next year, is that those rents are, the way they are calculated, they're going to spread out over several months.
Yeah, but we're aware of the lags in the calculation, and so we'll take that on board and take a look at that. But yeah, you're right. The core measure of PC inflation is still in the high fours, and the Dallas Fed trim mean 4.75 or so. So pretty high inflation in the U.S., even if you try to trim out some of the more volatile components. So we're going to have to get that turned around, moving in the right direction and back toward 2%.
So how are you going to do that? What does this mean for the restrictive terminal rate? The September SEP's medium target interest rate, 4.4% this year, 4.6% next year. After the latest data, what are your projections now?
Well, if you look at the September summary of economic projections, the so-called dot plot, it did seem that the committee was coalescing around further rate increases at upcoming meetings, even by the end of the year. So that seems to be the base case right now. Most of that has been priced in the market, so I would anticipate that that's having an impact right now. So that's good news if you're trying to get inflation down. But we'll have to follow through on that in the subsequent meetings this year and get the policy rate up to a level where we can put meaningful downward pressure on inflation. I think that's the main goal immediately ahead of us at the committee.
That was St. Louis Fed President James Bullard there. He sees an end to the front-loading of aggressive hikes by early next year. Now we're joined by Kevin Toze. He is portfolio advisor and member of the investment committee at Carmignac. Kevin, thank you for joining us. So Mr. Bullard sees a 2023 shift with end of front-loading hikes. Is this wishful thinking?
Well, it's a question of political courage, really, because we know that given the level of unemployment, which is still the key variable which will impact interest rates in the end, to have, this unemployment rate moving into non-inflationary levels, this would mean a potential severe, I would say, recession in the US in the area of 3%. For inflation to get back on track to the 2% target. So far politicians are quite keen on stating that they will do whatever they can and whatever it takes to bring inflation back to 2%. But we know that when times are getting more and more difficult, it will be more and more difficult for them to be courageous enough to move back to this target.
So Kevin, what does that mean? First of all, where do you expect treasuries by year end?
Well, on treasury markets, again, there's lots being integrated, lots being factored in. Terminal rates in the area of 5%. That's already a decent level of tightening being priced in. I'd say the main question is, when will the Fed pivot? When they, if they eventually pivot, and this would be at some point, in our opinion, at Carmignac, around mid-2023. And this puts, again, some pressure on longer-term interest rates, because it would mean that the Fed will be shifting a bit late, and hence it will be weighing on growth and hence weighing on longer-term rates.
So, Kevin, when you look at all of the concerning bad news across the world in terms of valuations, in terms of inflation, a possible recession, where are you putting your money right now?
Well, again, on equity markets, where we prefer to allocate assets is in those parts, I'd say, most recession-resilient part of the equity markets. Healthcare is one. We're having luxury companies publishing today in France, notably. That's another area where we like to allocate assets, those luxury names, which tend to be quite resilient, provided that the recession is not that severe, or the impending recession is not that severe. On fixed income markets, I'd say credit markets are integrating a fair bit of pessimism. We get very decent yields on those credit markets, between 8 and 10% on the, I'd say, most indebted part of the market, whether it's in Euro or in the US. And this integrates, I'd say, or embeds a very high level of default rates, which is, I'd say, unlikely to happen going forward. So that's, I'd say, the two areas where we would be allocate most of our assets these days.
Kevin, when you look further afield, I don't know whether you need to get the dollar call right. It feels like the riskiest position if you feel that it goes down and actually it goes ever higher. What's your take on dollar? And therefore, what does it mean for example, emerging market credit?
Yeah, well, so on the US dollar, there's been several factors helping, and that's clearly it was it's the best performing assets this year. There's probably more to go on that front. Why that is? Because again, the energy crisis is far from being solved in Europe. There's still this huge Damocles sort of potential gas stoppage in Europe. Another one is interest rates differential, growth differential, and on that front, I mean, if we do expect recession to be hitting the US over the next 12 months, it will likely be coming much sooner into Europe, and that's more likely to happen over the next coming 6 months. So this would mean that the dollar has further room to appreciate versus the euro going forward.
Kevin, very quickly, when you look at Europe, is now the right time to get in or out of bonds?
Well, again, on credit market, I would say it's a very right time to enter on those markets. Again, we are living through volatile times, to say the least. But you have carry with you when you're investing in those credit markets. And again, on the, I'd say, short-term part of yield curves, whether it's the US or the euro area, there's already a lot being priced in. I'd say on long-term euro rates, I'd be a bit more cautious, because there's still lots of supply coming. There's this natural, I'd say, price-insensitive buyer, which is the ECB, which is going to pull out of the market, and this is likely not going to help, I'd say, longer-term euro rates.
Okay, Kevin, thank you so much. Kevin Those there, a portfolio advisor, a member of the investment committee at Carmignac. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Liz Truss's premiership is looking increasingly fragile after a day of drama at Westminster. UK Home Secretary Suella Braverman, who was fired earlier in the day, criticised the Prime Minister and accused the government of breaking key pledges. Tensions came to a head later in a chaotic Commons vote over Truss's controversial plan to restart shale gas fracking, with reports of MPs manhandled into voting with the government. Now, President Volodymyr Zelensky has asked Ukrainians to consume electricity with, quote, awareness tomorrow. This after a grid operator warned of rolling blackouts because of damage to the country's power infrastructure from missile attacks by Moscow. Russia, meanwhile, has extended martial law in 4 occupied areas of Ukraine, limiting civilian movements. Bloomberg has learned that China is considering reducing the amount of time inbound travelers must spend in mandatory quarantine. This as the country's COVID-0 policy leaves it increasingly isolated from the rest of the world. Bureaucrats are looking at cutting quarantine to 2 days in a hotel and then 5 days at home, down from a total of 10 days of isolation at present. And French President Emmanuel Macron has used a fast-track decree to push through his budget, effectively bypassing the lower house of parliament. This after the bill was debated in France's National Assembly for several days, during which it became clear it wouldn't secure enough votes to actually pass. Macron's centrist group is nearing 40 seats short after losing its majority, and that was earlier this year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, Tesla sales fall short of Wall Street estimates, but Elon Musk tells investors the end of the year will be epic. We'll take a look at the numbers, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Tesla has reported sales that fell short of Wall Street estimates, citing delivery and production bottlenecks and prompting Elon Musk to assure investors that demand for his company's cars remains strong.
As our factories ramp, we're looking forward to a record-breaking Q4. So it really, knock on wood, it looks like we'll have an epic end of year.
Well, joining us now is Bloomberg's Global Autos editor. He's Craig Trudell. So, Craig, good morning. Thank you so much for joining us again. So, how serious are demand issues for Tesla?
So we entered this this earnings report with that being the real big question, right? There was kind of a troubling deliveries report just a few weeks ago, much shorter of pretty much everybody's estimates, concerning that production exceeded deliveries by about 22,000 vehicles, which is sort of unprecedented for Tesla. They usually sort of clean out by the end of each quarter. And you heard the knock on wood there that sort of allowed for, hey, maybe some things could still go astray in the fourth quarter. You also heard later on the call the CFO sort of allow for the idea that we should expect that again in the fourth quarter, more production than deliveries, more cars in transit at the end of the quarter. You also heard Elon Musk talk a little bit about, he did allow for the idea that demand is a little harder to come by because of economic headwinds. So this wasn't necessarily the effusive ebullience that you would have hoped if you were sort of rooting for Musk putting the demand concerns putting them to rest.
Yeah. So very quickly, is a share buyback possible?
Interestingly, Musk said that this is something that has not been decided by the board, but that didn't stop him from sort of floating the idea that something like on the order of $5 to $10 billion share buyback could be possible. So that may be some way to sort of put some concerns to ease about what the stock's been doing lately.
Craig, thanks so much. Craig Trudell there with the very latest on Elon Musk. Now we're joined by David Hunt. He's the chief executive of PGIM, which has more than $1 trillion in assets under management. We'll get his thoughts on the market outlook. That's coming up next, and this is Bloomberg. Trusts on the brink. The Prime Minister fires her Home Secretary just days after ousting her Chancellor as members of her Conservative Party begin to revolt. Risk evaporates. China debates a cut to quarantine rules, but stocks drop as inflation and growth risks continue to swirl. Plus, out of power, Tesla slides post-market as delivery and supply bottlenecks hit third quarter results, but Elon Musk promises an epic year end. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the news cycle, relentless, especially relentless at this moment, from the mayhem in Downing Street to earnings season next week. But my next guest likes to look at the long-term picture for the markets. Well, David Hunt is president and chief executive of PGIM, which has $1.3 trillion in assets under management. He joins me here in the London studio. So, David, welcome to London.
So nice to be with you, Francine.
And welcome to of course, our studio. When you look at inflation, David, this is the biggest concern for asset managers, for private equity, really for any kind of investor, and the people also that are trying to make ends meet. How will this end?
Well, I think that the first thing to recognize is that actually it's very different around the world. It's easy to kind of extrapolate maybe from your home country, but in China, for example, inflation is not a big deal and the economy is shrinking. In Japan, inflation is not a big deal and there's almost no growth anywhere. In the U.S., we have high inflation, which is pretty broad-based. And in Europe, we have high inflation, but which is more targeted toward energy and food and a few others. So it's a very different story. And I think it does lead you to different conclusions about how things begin to come undone at the end of this. Personally, I think we're headed into a kind of post-COVID regime, which is very different. It will be higher inflation. It will be still fairly low rates by historical standards, and unfortunately, we'll go back to somewhat of a low growth phenomena in the developed world.
So what does it mean, your offerings for your clients, how will they change? Because it's going to be much more difficult to make money, but it's easier maybe to lose money in this kind of environment.
Well, yes and no, and this is where it's a wonderful thing to be a long-term investor. While it's undoubtedly true that if you were a big holder of bonds at the moment and rates went up on you like that, you're feeling a little bit poor. But in truth, over the next 18 months, the money that we put out, we think is going to be some of the best money, actually, that we invest. This is what happened after the GFC. I mean, we now have an entry point, and we can talk about when that is, but there is an entry point now, I think, to put money to work at far more attractive terms than we've seen over the last 5 years. So I think there's real room for optimism for long-term investors, but you've got to be able to ride this out a little bit.
Right. So first of all, how do you not catch a falling knife? And so what is the right entry point?
Well, I think that is the million-dollar question for sure. And for us anyway, what we're really watching is the rates of inflation and trying to figure out when those are indeed coming down. And you can see some early signs. I mean, the base effects will naturally bring these down for sure. But I do think inflation is likely to stay higher than the market anyway believes that they will. And the reason for that is actually how much money has been put into the economy by fiscal stimulus, whether that's here in the UK or in the US. We've had more than 10% of GDP pumped into consumers and businesses' wallets. And they're spending that, and there's a lot of momentum behind it.
But do you worry about zombie companies? And to your point of actually putting capital to work, can you demand higher fees in this volatile environment?
So there's no question that a lot of the money that has gone into the economy for COVID has meant that the natural process of creative destruction probably has been delayed a little bit. And I would say we're going to see that more in Europe than the US, where much of the support actually went to unemployment insurance, whereas much of the support in Europe actually went into companies. But nevertheless, I do think gradually you will see the kind of creative destruction. You will begin to see, as we head into recessions, that there will be a rise in credit losses and defaults. And that's a natural part of beginning to get demand under control. And central banks want that.
But nothing like an 07, 08 crisis.
Actually, very different. I think the analogies are not that helpful. The GFC was fundamentally a liquidity issue that was driven by banks that were undercapitalized. We actually have the opposite problem now. The banks are in very good shape. The GFC was not really a credit issue. This, I think, if we have kind of a mild to moderate recession, at least in much of the developed world, which will be driven by higher rates, you're going to have actually more of a credit issue than we did before, but I don't think you're going to have the same kind of liquidity issue.
I mean, if you look at some of the credit issue, I mean, there was a bit of liquidity concern for some of the pension funds, the longer-dated pension funds here, which I'm sure you follow very closely.
Very.
A couple of concerns, of course, with shadow banking. How do you stress test, leverage companies at the moment that are okay at 1% interest rates, not so much at 5%? So
it's, I'm really glad you raised the leverage question, because whenever the question of kind of where should we worry, what's going to break, the answer to that is almost always follow the leverage, because that, oftentimes driven by the use of derivatives, is in fact where you see things that people thought were relatively tame, all of a sudden with fast moves in prices, can't make margin calls. And that's what you saw in the gilts market here. And that's what we saw actually, a couple of years ago in the U.S. government's market. So we're watching those markets that have built-in leverage very carefully.
To what? Get out or
no? Just
or
to monitor what the leverage situation is, to make sure, one, we have enough liquidity in our portfolios so that clients can move in and out when they want, and secondly, of course, that we do have dry powder that if prices moved dramatically lower, that we could actually move in force for sure.
David, are you here to do business? I wonder what you make of all the political turmoil, and we mentioned the pensions, but also yesterday was a pretty extraordinary day for the UK.
No, it really has been absolutely an amazing week to be here for sure. And I'm sure you don't need yet another kind of commentator on the UK political situation, but I can say that markets are very clear about what they expect. And that at these heightened levels of interest rates, having big unfunded liabilities by the government is really not going to be acceptable. And I think that was sternly delivered here by markets. But that should be watched in the U.S. and in other markets. Italy comes to mind, where for sure the same kinds of problems exist. So I think this has been a very important week for the world to watch.
David, what are you most optimistic about? I mean, we do, there's a lot of things that could go wrong, and we talk about this day in, day out. But for the chief executive of such a, respected and large company like PGIM, are 2-3 years, will we be in a better place than we are now, or are there opportunities for you?
So I remain extremely optimistic as an active investor. I mean, I really do think that at these levels of prices, that as we go through the recession, we hit the bottom, of course, the markets will come back faster than the real economy. We will actually see really terrific buying opportunities. By any measure right now, rates are too high, spreads are too wide, and the real question for many of us is when to make that move, not whether, because I think the next 24 months will actually be very attractive, and people should be optimistic as long as they have a long-term view.
But are your clients optimistic, or have they been afraid? They haven't been trying to...
No, and we've seen one of the biggest differences, I think, that I can remember between institutional investors who have not changed their SAA. There's been no panic whatsoever. In fact, many of them have been selectively kind of rebalancing into this. And retail, where you have seen a lot of big outflows and people just kind of running from anything that said fixed income. But the two are very different. And so I think most long-term investors are riding this out and feel as if they have an opportunity now in front of them.
How difficult is it, to go from what we've lived through in the last 12 years to the next 10 years with QT, with central banks just taking on a completely different role?
It really is. I mean, so I mentioned this kind of new regime, and so what we're working the most with clients on is, so if inflation is higher, what does that mean for your portfolio? If rates are going to be a bit higher, what does that mean? If emerging markets no longer really operate as a block, how do you break all of that up? So it's a very interesting time to be an investor.
Yeah, certainly not dull, David. Thank you so much for joining us today. Come back soon to London and here on air. David Hunt there, President and Chief Executive Officer of PGIM. Now, in the meantime, let's also check on pound. We probably need to also check on gilts. The focus is on the politics. Now, we did hear from Mr. Broadbent of the Bank of England. It's not clear if rates must rise as much as markets see. Remember, it is November 3rd that we have the Bank of England decision. It's on October 31st that we're expecting more details from the Chancellor in terms of fiscal spending. But then, of course, $1 million question is, does the Prime Minister stay? What comes if she goes? And how does that change the fiscal equation? Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Hermes sales have surged as luxury shoppers in China return to stores after COVID restrictions eased, snapping up Birkin and Kelly handbags. Revenue rose 24% in the third quarter, excluding currency swings, topping analysts' estimates. The results provide more evidence that producers of luxury goods remain mostly immune to the wider squeeze on spending. Now, Philip Morris has increased its offer for smokeless tobacco company Swedish Match. The total value of the revised offer from the Swiss-based tobacco giant amounts to about $15.8 billion. A takeover would give Philip Morris a vast distribution network over in the US, the world's largest market for smoking alternatives. It says it will not increase the price further. And Bloomberg has learned Saudi Aramco is pushing ahead with plans for an IPO of its oil trading business in what would be one of the largest listings this year. Sources say the firm is working with advisors for a listing in Riyadh as early as this year, which could value the unit at more than $30 billion. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, coming up, EU leaders gather in Brussels on the agenda, sanctions on Iran, protections against energy sabotage. That's up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance early edition. I'm Francine Lacqua here in London. Now, European leaders gathered in Brussels this morning for a highly anticipated summit dominated by energy and the war in Ukraine. Now, the meeting comes after the head of the Commission, Ursula von der Leyen, unveiled a sweeping plan to bring down energy prices. Now, to debrief us all, we go to our Europe correspondent, Maria Tadeo, who's covering the summit. Maria, great to speak to you again. There's a plan of action, but is there the political consensus to get it done?
Yeah, Francine, and frankly, that is the key question today, and there is no simple answer for it. We've now seen the plan put forward by the head of the Commission. We've talked about this dynamic, very dynamic price cap, the idea of a circuit breaker in the derivatives markets, too. We've talked about the joint purchases, but ultimately, these are ideas that will only fly if European leaders agree to them and give it the green light. Now, I am being told today the sticking points essentially remain. The Germans continue to be very worried about the implications of any cap whatsoever. They worry that could limit supplies, and their priority is to get a hold of supplies. And then, of course, you have this growing coalition of countries that want to see a price limitation being put forward. So, Francine, overall, I'm being told consensus at this stage. A lot can change in 24 hours in Brussels, but right now it looks in many ways that this is going to be a long but also very thorny discussion tonight.
Yeah, and to be fair, usually a lot does change in 24 hours in Brussels. Maria, thank you so much, Maria Tadeo there with the very latest from Brussels. Now, the energy crisis forcing governments to rethink how they generate power. One alternative being considered, Turkish power ships. Now, these giants floating power plants are run by Turkey's Car Power ship. They burn fossil fuels and are usually spotted on the coastlines of Africa and emerging markets. But the company says it's now in talks with 4 European Union nations. Well, we're now joined by Zeynep Harazi, Managing Director at Car Power ship. Zeynep, thank you so much for joining us. It does seem, the idea is not as green as many governments would like it in Europe. The idea may be important just to make sure that we don't have blackouts. Germany, as far as I understand, is now backing off this options. Who are you talking with in terms of governments in Europe?
Thank you very much. As Car Power ship, we have built conventional land-based power plants that are combined cycle, that are dual fuel, inside ships. And we've done this speculatively before any contract so that these power plants can be mobilized in less than 30 days. So these technologies have been used in Europe for the many decades before, and they are no news to the European utilities. The only difference is that they are built inside ships rather than on land. We have been speaking with the leading 4 economies in Europe to provide electricity. And we have been in very mature discussions and hope to have a couple of the ships operating before the winter peak so that we can lower the electricity bills and make sure no industries and no households get blackouts.
Zeynep, so who would like to buy this? If you look at some of the economy ministers or energy ministers, is France looking into this? Are they ready to accept and actually use some of the Car Power ships? How much do you think you'll be present in Europe in 6 months from now?
We hope that if we can go through the regulatory processes, which are made for conventional project development, so the standard regulatory processes take approximately 1 year. If we can expedite that process to implement a fast-track solution, we should be able to commission and make readily operational 2 gigawatts of electricity in Europe in less than 60 days from today.
Zeynep, when you look at some of, the countries, are you having talks with Paris? Is it something that they'd be interested in? We understand that Germany may not be looking at this option, but that France could be.
We are speaking with all 4 of the leading economies in Europe. They have been requesting us to keep their names confidential for time being, for security of supply reasons. So with your permission, we will respect our potential clients' request, but I would be very happy to share that information first week of December, when hopefully all the power ships will be operational.
Yeah, and for the moment, I understand there are 33 power ships in operation across Africa and other emerging markets. How long are these contracts?
So the shortest contract we have is 1 year, and the longest is 25 years. These ships have a lifetime of more than 30 years, but it is very natural to use the ships for 3 to 5 years with a medium-term contract, and then once understanding the merits of it and how low cost the electricity generated from it and how reliable it is, then provide for a contract extension. That flexibility is not possible with a land-based power plant since the structure is fixed and it cannot be moved, but we can provide that flexibility with floating power plants.
Zeynep, thank you so much. Zeynep Harazi, there, Managing Director at Car Power ship, joining us this morning. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Liz Truss's premiership is looking increasingly fragile after a day of drama at Westminster. UK Home Secretary Suella Braverman, who was fired earlier in the day, criticised the Prime Minister and accused the government of breaking key pledges. Tensions came to a head later in a chaotic Commons vote over Truss's controversial plan to restart shale gas fracking, with reports of MPs manhandled into voting with the government. Now, President Volodymyr Zelensky has asked Ukrainians to consume electricity with, quote, awareness tomorrow. This after a grid operator warned of rolling blackouts because of damage to the country's power infrastructure from missile attacks by Moscow. Russia, meanwhile, has extended martial law in 4 occupied areas of Ukraine, limiting civilian movements. Bloomberg has learned that China is considering reducing the amount of time inbound travelers must spend in mandatory quarantine. This after the country's COVID-0 policy leaves it increasingly isolated from the rest of the world. Bureaucrats are looking at cutting quarantine to 2 days in a hotel and then 5 days at home, down from a total of 10 days of isolation at present. French President Emmanuel Macron has used a fast-track decree to push through his budget, effectively bypassing the lower house of parliament. This after the bill was debated in France's National Assembly for several days, during which it became clear it wouldn't secure enough votes to pass. Macron's centrist grouping is nearly 40 seats short after losing its majority. That happened earlier this year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, the British cabinet has become something of a revolving door, and the Prime Minister is under immense pressure to be the next person to leave. We have the latest from the mayhem in Downing Street. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this is a picture for gilts. Again, there's a move across the board in fixed income, but certainly you can see the 2-year yield, the one that's most sensitive to everything that's happening in the next 2 years, 3.54. So it's been a day and an evening of political turmoil in the UK, with Liz Truss's premiership looking close to imploding. Let's bring in Bloomberg's Lizzie Burden now. So, Lizzie, where does it actually leave the Prime Minister?
Well, my colleagues Alex Wickham and Kitty Donaldson put it well. They described yesterday as not just ideological rigidity, not just political misjudgment, but amateurishness for all the world to see. It was the resignation of Home Secretary Suella Braverman and then her scathing resignation letter. We're going to hear from her with her resignation speech we expect in the Commons later. Then the vote on fracking and all the chaos surrounding the allegations of manhandling to get a Tory MP through the right side of the lobby to vote. The MP involved and the ministers, I should say, have denied that, although there were multiple eyewitnesses. And there was, of course, confusion as well over whether the fracking vote was a confidence vote in the government or not. And that has flip-flopped multiple times. And the chief whip and the deputy whip quit and then unquit. So in sum, Francine, it has been absolute chaos. The pressure is for Liz Truss to quit, and we're just waiting for the lectern outside number 10.
Yeah, I have to say, so many commentators commenting that it's now like Italy, and so many Italians being offended by that. In the meantime, the Bank of England Governor Ben Broadbent also saying that it's not clear that UK interest rates need to rise as much as markets are betting at the moment. Our Lizzie Burden outside number 10. Bloomberg Surveillance Early Edition continues. This is Bloomberg.
We're in a decelerating environment right now, and the market leadership to us just doesn't make a ton of sense.
FX is a relative game. The dollar remains, first amongst equals in this.
We will not see weakness in the dollar until the other economies start to do either as well or better than the US.
I haven't seen enough evidence that there's been any sort of break in the way things function. Yes, we're going through a painful period in the markets.
It's a very difficult environment, right? We're at market breaking levels, and in almost every asset class.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. On the brink, Liz Truss's hold on the premiership is hanging by a thread as many members of her UK Conservative Party agitate for her to go. Tesla slides, delivery and supply bottlenecks hit the EV maker's third quarter results. CEO Elon Musk tries to assure investors, promising an epic year end. And a sweetened offer, Philip Morris says its new bid for Swedish Match is its best and final as it targets the world's largest market for smoking alternatives. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, hard not to be distracted by the politics here in the UK, but away from that, the rising yield environment is still very much in focus.
Yeah, and that is weighing on risk appetite really around the world, Anna. Definitely true in Asia overnight, where stocks were down pretty much across the board. Though what's interesting is the MSCI Asia Pacific Index as a whole cut its losses about in half, only right now down about 0.75% after earlier losses of more than 1.5%. And the reason for the rise off of session lows was some Bloomberg reporting that China may be looking to cut its COVID quarantine measures shorter, potentially just 2 days in a hotel than 5 days at home. So that would be a reduction and an easing of some of the really strict COVID zero protocols there. So that helped things out, but still a down day for equities. Also a down day mostly for bonds, in that yields are moving higher around the world, really seeing follow through upward pressure on yields like we saw in treasuries yesterday in the overnight session, including in Australia, where the 2-year yield rose 12 basis points to 351. That's the highest going back to 2012. And of course, the Japanese bond market has not been immune to these forces. We have seen the 10-year JGB yield once again above that 25 basis point cap that the Bank of Japan would like to keep there, which is why they announced an unscheduled bond buying program to try to keep that yield curve control. And of course, that is contributing to a weaker Japanese yen. We are on intervention watch because we are very, very close to 150 per dollar, Matt. Right now, dollar yen trading at 149.92. So that's a pair to watch very, very closely.
Yeah, we won't know until we do, and then markets will react very sincerely if that happens. Take a look what's going on in futures. We are down about 0.5% on S&P futures. Now, of course, Tesla's an S&P stock, but we're watching that and it's dragged very closely. Tesla on the NASDAQ futures down 0.9%. So you could see tech stocks take a big drop, but just keep in mind how many tech stocks these days are in the broader index. The 10-year yield continues to rise, and really yields across the curve are rising to cycle highs, right? We're looking at 460 basically on the 2-year right now, 416 on the 10-year. And then NYMEX crude up 1 1/3, $1.36, up 1.5%, a little bit more than that, to 86.91. So we do see a little bit of gain there. That may be a little bit of optimism across the oil market as we hear news that China is considering cutting the COVID quarantine time for inbound travelers. Anna, what do you see in terms of the European stock market?
Yeah, we did see that news around China pop oil higher. It didn't keep its impact on equity markets, but some of that pop higher in oil did last, Matt, as you point out. I see a really divergent picture across European equity markets, depending on the sector weighting of these different geographies. So the London market down 0.1% or so. The DAX in Germany really underperforming because it doesn't have the weighting towards oil names. It also doesn't have the luxury assistance that France has today. More on that in a moment. It is the energy sector that is the only one that is going higher across Europe today, and I picked that out as one of the sectors to follow today. Energy markets, then energy stocks rather, up by 1.4%, but that is the only sector moving higher. Everything else moving negative today. This is the 2-year yield. I picked this out for this for the gilt market, of course, 3.54%, and we do see yields going higher. And to Matt's point, this is a global phenomenon. This is something we're watching in other geographies, in Germany and in Italy. For a little time this morning, it looked a little bit nervous, as if the gilt market was going to price in higher yield gains than other markets, but that doesn't seem to have been the case. Now it's sort of on par with the rest of what's going on in Europe. Not all that dissimilar to what's going on in the German market this morning. And Ericsson is down by 14.7%. The telecom equipment maker, the profits disappointing. They're under pressure from an activist investor. They're also guiding that it's prudent to expect that some of their customers might cut back on spending, given all of the headwinds that they're facing. And Hermes, this is a luxury goods company. It was up much more strongly than this, only up by 0.3%. Not doing as bad as had been anticipated in China is one part of the story. And stop me if you've heard this before. before. American tourists in Europe with strong dollars spending on luxury items seems to be coming to the aid of the luxury sector. Let us talk about something that's happening here in London. It's been a day and an evening of political turmoil in the UK, with Liz Truss's premiership looking close to imploding. At Prime Minister's questions yesterday, the opposition Labour Party leader Keir Starmer laid out a litany of government U-turns.
2-year energy freeze, gone. Tax-free shopping, gone. Economic credibility, gone. And her supposed best friend, the former Chancellor, he's gone as well.
For more, let's bring in Bloomberg's Lizzie Burden at Downing Street. I mean, that was yesterday lunchtime, Lizzie. Since then, she obviously had that appearance in Parliament. And then we had a really troubled vote in Parliament, really messy, chaotic scenes in the House in Westminster. Where does all of this leave Liz Truss?
Well, Anna, Liz Truss only added to the list of things that are gone from her premiership in the hours that followed Prime Minister's questions. Gone is another holder of one of the great offices of state, the Home Secretary. Gone, of course, is much of her economic strategy, and really her only connection to her core vote now is Brexit. And yet her cabinet is now filled with Remainers. The new Home Secretary, Grant Shapps, voted Remain, and he also supported Rishi Sunak in the summer leadership election. But crucially, gone is the party's dignity. According to Tory backbenchers themselves, they were livid last night because of what happened around the fracking vote. There were allegations of manhandling of an MP by two senior ministers to go in the right lobby and vote the government's way. That's been denied by the MP involved and the ministers involved. But still, there are calls from both MPs in the Tory party and the Labour Party for an investigation. So the wind has changed in Westminster today. It had seemed that Liz Truss was going to be allowed to cling on until at least the Halloween budget, but now the pressure is mounting for her to resign today. We're just waiting for a lectern to arrive.
And if that lectern does arrive and she does indeed resign, Lizzie, what happens next? Who would replace her?
Well, interestingly, the polling shows a difference. The party membership would like Boris Johnson to come back, but the population would like Rishi Sunak, who of course lost out to Liz Truss over the summer. He's the former Chancellor. You may see the 1922 committee of Tory backbenchers opting to anoint a successor to skip this very divisive leadership election process that we saw over the summer, bypass the party membership because we see where their decisions lead. But the trouble is, whoever they pick would have a seriously diluted mandate. That would raise this pressure for a general election, and no Tory wants that, given it already looked like the Tories were going to get annihilated at an election. Yesterday's only added to the chaos.
All right, Lizzie, thanks very much. Lizzie Burden, they are reporting from Downing Street. We are waiting for any changes there, and we'll bring them to you the minute they happen. Now, let's get back to the markets. Tesla shares down after the EV maker reported sales fell well short of Wall Street estimates, citing delivery and production bottlenecks. The miss prompted Elon Musk to assure investors that demand for his company's cars remains strong.
As our factories ramp, we're looking forward to a record-breaking Q4. So it really, knock on wood, it looks like we'll have an epic end of year.
Joining us now is Craig Trudell, Bloomberg's Global Autos editor. So what do we know? I mean, Craig, it looks like Tesla's sales fell about $600 million short of the street's estimates. If you factor in even $100,000 a car average selling price, that's 6,000 vehicles.
Right. I think, there was also some mention of dollar strength playing a part there. I think you also, I think, just have to step back a little bit and do sort of acknowledge that this company is growing quite a bit, right? Revenue did increase by 56%. Having said that, they've really sort of set a high bar for themselves by, the talk along the lines of what we just heard from Musk of, an epic outlook and lots of talk about record-breaking results. This is a case where this is a company that's gone from, 2 car plants to 4 in the course of roughly a year. And so you would definitely expect that they would have record deliveries and so forth. I think that the big concern going into this was that, deliveries fell quite short of production last quarter. They sort of allowed for the fact that they expect that to continue in the fourth quarter, so that, sort of allows that demand concern to fester a little bit. They also expect to come up a little short of their 50% annual growth outlook for this year. And so, they didn't necessarily put totally to bed this concern about demand. And maybe what we'll see in the coming weeks is perhaps some price cuts from the company after many price increases because of all of the material costs and so forth that prompted those increases.
Well, that would be interesting. That would be a pivot in itself. We think about a pivot from a macro perspective, a focus on inflation turning to growth. If we saw that from Tesla, that might tell us something interesting. Elon Musk was talking and acknowledging some of the weak spots in Europe and crucially in China.
Yeah, absolutely. I think he talked about the idea that demand is, and I quote him, a little harder to come by. So, I think he's alluded to the idea that the property market in China is a drag. Here in Europe, it's an energy crisis. He alluded to the idea that the Federal Reserve is raising interest rates and sort of clings to his belief that they'll actually have to bring them back down a little bit, which is definitely a sort of contrarian view, I think. But, I think he did sort of allow for the idea that, demand, while it is strong, it's going to be a difficult environment for them, and that certainly is making it harder than it's been for them in the past.
All right, Craig, great to get an update from you. Thanks so much. We'll continue to follow Tesla this morning, obviously, as the shares look set to fall and could be a big drag on the broader market. Let's get to some big deal news. Philip Morris has increased its offer for smokeless tobacco rival Swedish Match. The total value of the revised offer from the Swiss-based tobacco giant amounts to about $15.8 billion. Now, a takeover would give Philip Morris a vast distribution network in the U.S., again, which is the world's largest market for smoking alternatives. Bloomberg's Andy Hoffman joins us now. And Andy, this is really interesting because, of course, Philip Morris, that's an American company, an American name. The breakup with Altria just 15 or 16 years ago. Is this going to be enough now to get it back in the U.S.? Are the hedge fund shareholders of Swedish Match going to get on board with the deal?
Good morning, Matt. Yeah, this is the big question. I mean, what we're hearing initially and early on is that this increase to about 116 krona from 106 krona initially should be enough for some to tender. However, the big question is Elliott Investment Management. That's the hedge fund that owns, we believe, more than 7.5% of Philip Morris International. And what they decide to do and whether or not this is enough for them is the big question. We haven't heard from them so far, and so we don't know where they are. Indeed, as you were saying, this is all about getting back into the U.S. market for Philip Morris International as they move to what they call smoking alternative products. And the U.S. is the largest market for smoking alternative products, things like vaping, nicotine pouches, which is what Swedish Match makes. And that's why Philip Morris, which right now is not in the U.S. market, wants to get there.
Well, and on that note, how does this deal with Altria to sell IQOS in the U.S. fit into this equation?
Right. Well, this is also a key move. This is a sort of interesting strategic move by Philip Morris at this point. What it does is it gives them, they're spending about $2.7 billion in this deal with Altria. It gives them access to the U.S. market to sell the IQOS product, which is a heated tobacco product. It's not tobacco that you light on fire and inhale. It's that you heat and it vaporizes. And Philip Morris says that is a smoking alternative, and that is better. At this point, Philip Morris was not able to sell that product. That was Altria's product to sell in the U.S. But this deal will give them that right once they begin manufacturing the IQOS product in the United States. That should be in about 18 months. And it gives them leverage here in the fight with the Swedish Match shareholders because they say, well, this is our entrance into the U.S. market, and perhaps we don't need Swedish Match if you're not willing to accept this offer, which Philip Morris says is their best and final offer.
All right, Bloomberg.
Andy, thanks so much.
Andy Hoffman.
Apologies, Kailey.
Jinx, Anna. Andy, thank you very much for joining us. Now let's quickly take a look at some other company stories we have our eye on this morning, with some stocks moving in pre-market trading here in the U.S., all of them related to earnings that were reported after the bell yesterday. First up, IBM topping expectations on revenue, plus boosting its full-year forecast, really signals still strong demand, which is helping them contend with dollar strength that a lot of companies are facing right now. IBM up about 3% before the bell. It's also a positive story for Las Vegas Sands, the casino operator. Its adjusted property EBITDA topping expectations. Strength for Marina Bay Sands in Singapore helping offset a still weak Macau. It is up a little more than 1%, but sinking to the downside is Alcoa, the big aluminum maker, posting a surprise loss. They're dealing with higher costs, but slumping prices as well for aluminum itself. So all of that taking down the company's performance and the stock with it. It's down about 9% in early hours. Anna, now it's your turn.
Now it is my turn, and that was definitely worth a mention, so I'm glad we got there. Coming up on the programme then, Kailey, Aneeka Gupta joins us, WisdomTree Director of Research. So much to talk about, from UK gilt markets to the weakness in the yen and the possibility of intervention. What breaks if we see further intervention? And talking of the markets and the macro picture, we have been hearing from the St. Louis Fed President, Jim Bullard. He says it's important the Fed follow through on expected rate hikes. Part of our exclusive interview ahead.
November meeting has been more or less priced into markets at the 75 basis point number. Again, you know, I think you do want to wait till you actually get to the meeting, see what the situation is there. The December meeting is a little farther away. We will have more data at that point.
Welcome back to Bloomberg Surveillance. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards with us out of London, and we are looking at yields that are at cycle highs really across the curve. I was interested to see 2-year yields up to almost 260 when I logged into my terminal this morning. 5-year yields at 237, 10-year yields at 415. So this is, I think, just another example that there are reasonable alternatives to stocks. So some real competition coming from rates. Let's get over right now to Phil Serafino, Bloomberg Senior Markets Editor, to talk about this. So Phil, you know, there was an idea that maybe we hit a bottom. Bank of America said their survey screams capitulation. Nonetheless, it seems that there's other stuff to buy. You don't need to get the dip in equities just yet.
Yeah, it's been pretty hard to make the case that the worst is over. It's time to come rushing back into stocks. As that chart shows, you know, if you're getting 4% plus on treasuries, that's not too bad at a time when the outlook is not great. Everyone's been waiting for that capitulation. You know, even Bank of America says they think we might get the people throwing in the towel early 2023. So that means several more months of, you know, sort of the market grinding lower. And that's just, you know, that's just not an environment that's going to encourage people to come back into the market, especially given the economic news. And you played that clip from Bullard from the Fed basically saying 75 basis points is baked in. You know, rates could be going higher still.
Yeah, and just to labour the capitulation point a little more, Phil, because it is something that so many people are watching for and waiting for. I spoke to one guest this morning who said, no, we're not close to it. Maybe it doesn't come till sometime in 2023 because we haven't seen yields go as high as they are going to go yet. And that, I suppose, is the missing data point.
Absolutely. And, you know, there's just no urgency on the part of investors to come in. You get these little mini rallies like we saw at the start of this week, where, you know, the selling kind of peters out a little bit, people start to creep back in, but there's just no follow through, no momentum. And, you know, the economic data is probably going to continue to be very difficult for a while. You know, we haven't really seen a huge uptick in unemployment, and you almost want, you want a sense that things have gotten really bad in the economy before people start to look for that bottom.
Phil, thanks so much. Bloomberg's Phil Serafino with the latest on the markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal to find the Markets Live blog. Lots on there about energy prices, the yen, and UK politics. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. On the brink, Liz Truss's hold on the Premiership is hanging by a thread as many members of her UK Conservative Party agitate for her to go. Tesla slides, delivery and supply bottlenecks hit the EV maker's third quarter results. CEO Elon Musk tries to assure investors, promising an epic year-end. And a sweetened offer, Philip Morris says its new bid for Swedish Match is its best and final as it targets the world's largest market for smoking alternatives. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, it seems European equity markets struggling to find any momentum. Yes, we've got the political chaos, not really jumping on the latest news lines out of China, and wary of volatility in government debt markets.
Yeah, absolutely. I mean, we're seeing rising yields here, which is, I think, one of the reasons that you see lackluster demand for stock, or actually the opposite of that, right? S&P 500 futures are down 0.4%. NASDAQ futures are down 0.75%. The concern here, right, some earnings stories, Tesla having to defend demand for its products, seeing some weakness this morning, and that could drag on these two indexes. Here you see the 10-year yield right now rising even less than 1 basis point, but still at 4.14. And we showed you earlier the 2-year yield at 4.59 right now. So across the curve, we're seeing those yields continue to rise. And the question of whether or not we've hit a bottom in stocks is also being asked of yields, right? Have we hit a high in yields? Have we hit a low in terms of the price of bonds? NYMEX crude up about 1.33%. We did have a pop this morning in crude and some other commodities on that news that China may reduce the quarantine time for inbound travelers. It wasn't enough to sustain a rally in stocks, but it certainly has sustained a rally in crude as we see Brent rising as well. Kailey, what do you see in terms of pre-market movers?
Well, there's a lot of earnings-related movers to keep an eye on. One of them being Tesla, which, as Anna mentioned, disappointed in its report after the bell yesterday. The issue really is on delivery. Supply chain bottlenecks making it difficult for Tesla actually to get cars to people. And as a result, the top line missed expectations. And yes, Elon Musk is trying to say it's not a demand problem, but still shares being weighed down in pre-market trading to the tune of about 5.6%. It's an even bigger drop, though, for Alcoa, the big aluminum maker. It's facing higher costs, but prices of aluminum are going down. All of that adding up to a surprise loss for the company in the quarter they reported. So it's down about 9%. One more positive story out there, though, is IBM. It actually topped expectations and raised its forecast, signaling strong demand. It's being able to withstand a stronger dollar and those FX headwinds as well. So IBM up about 3% before the bell, Anna.
Yeah, quite a lot of divergence, it seems, across the reporting, the corporate reporting schedule so far, Kailey, in this reporting season. The European markets are taking all of that on board and showing some moves lower. The Stock 600 in Europe down by 0.6%. And not many sectors, no sectors going in positive territory, apart from energy. That seems to be one area where we are managing to eke out some positive ground. The UK 2-year yield, 3.49%. Actually a bit of a turnaround here. We had seen that we're now seeing buying of UK debt. We had seen some selling. We had seen those yields going higher. Now we see them coming a little bit lower. But the point remains that we're seeing the UK market move kind of in step with the rest of the European markets today. And that is something, really, given the political turmoil that we've seen in recent weeks, and it continued overnight. Ericsson down by 16%, just shy of. This is a telecom equipment company, of course, and they missed in terms of their profit that they reported to the markets. They're under pressure from an activist investor, and they are also being cautious about what happens from here, saying it would be prudent to assume that some of their customers reduce their spending on, for example, 5G. Hermès is the luxury goods company out of Paris. And of course, we've seen a number of luxury goods companies having quite a good quarter, reporting better than expected in China, but also saying that American tourists in Europe are spending those strong dollars, Matt, and that is adding up to some better results for the sector.
All right, we'll continue to watch, obviously, all those luxury goods companies. It really is a threat, I think, in today's markets. Let's get to Aneeka Gupta right now, WisdomTree Director of Research, and take a bigger view first, the 35,000-foot view, Aneeka. The question of whether we hit a bottom in markets has been asked. Bank of America came out with a survey yesterday saying that the results scream capitulation. Nonetheless, it looks like we're going to be down again today as rates continue to rise. What's your view?
I couldn't agree more with them. A very good morning, Matt. And we kind of share the same view because we have seen equity market volatility remain high. as monetary policy is increased, at an excessively sharp rate across central banks in developed markets. And now, as we enter the Q3 earnings season, the key focus is really going to be on current macroeconomic challenges that are being priced into stocks. And that's going to be alongside forward guidance. So investors are going to be looking very, very closely into what that forward guidance really is. And the reality is the brief rally that we've seen so far has been owing to some, pretty good earnings coming in. But inflation and the strong dollar, I believe, are obscuring the real earnings picture. So I think higher discount rates will continue to deflate earnings multiples, and it's still too early to say if we've hit the bottom.
Okay, and those higher discount rates, of course, links into a conversation about how high yields go then, Aneeka. And I wonder if you could weigh in on that in the UK, from a UK perspective. We've just heard from Broadbent of the Bank of England saying that UK rates may not rise as much as markets see, which does sound a little more dovish than some of the commentary of late. That's from Ben Broadbent, Deputy Governor at the BOE. How aligned do you think are market expectations of hikes and the bank's intentions?
Very good morning, Anna. Yes, there is a slight disconnect, and that's because over the past few weeks, we've been through a stream and a raft of changes coming in from the government and the Bank of England. So we started off with this launch of the original mini budget. We've then taken a complete reverse course on the mini budget and a reverse on fiscal policy. And now the key focus really is on quantitative tightening being delayed until next year. Now, given the fact that we've taken such a sharp turn on fiscal policy, there's a very strong likelihood of that really impacting the market on the downside as well. So while originally our expectations for the Bank of England was to come in with an aggressive 100 basis point rate hike, we now think there is a possibility of them lowering that to around 75 basis points. Because if you think about it, this reverse take on fiscal policy is also likely to impact, demand going forward. We're seeing very high inventory levels. We're seeing a drag on consumer demand. And the key focus for the Bank of England is they need to loosen this ever so tight labor market, that has been tightening even more since Brexit. So to get from a 10% down to a 6% was relatively easy. But now to loosen that from 6% all the way down to 4% is going to be a lot more harder.
Aneeka, on the subject of fiscal policy, how are you thinking about that in the U.S. and the implications of the midterm elections for that as a potential market risk event that's now less than 3 weeks away?
Morning, Kailey. Yes, that's a very interesting question. And what happened in the bank in UK and, with the Bank of England having to step in, it is a big stark reminder for the rest of the world to not make the same mistake that the UK has made. So I think for now, the US will tread very carefully on its take for fiscal policy. We do have fiscal deficits at a very high level, and I think given the fact that now we're entering the midterm election period, focus is going to remain on managing that fine balance between not having very loose fiscal policy alongside the fact that you've got the Federal Reserve on an extremely sharp, tighter monetary policy path.
Okay, Aneeka, thank you so much for joining us. Where will the next geography for volatility be? Aneeka Gupta joining us there from WisdomTree with the latest on the markets. And coming up, St. Louis Fed President Jim Bullard expects a shift in Fed policy early next year. Part of our exclusive interview next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Blackstone President and COO Jonathan Gray. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, St. Louis Fed President Jim Bullard says he expects the central bank to end its front-loading of aggressive interest rate hikes by early next year. He spoke exclusively with Bloomberg's Kathleen Hayes.
I do think they will have an impact, and in some ways have had an impact. I would cite the housing market in particular, where it appears that increase in rates has really changed the dynamics there. So that's someplace that I would say there are not long and variable lags. That market anticipated Fed moves that before they were even in train this spring. And so that's a place where we've seen impact right away. But, it's a big ship, and it takes a while to steer the ship. And so the housing market is not the whole economy. So
it certainly isn't. And it's certainly not one of the main things driving inflation now. Of course, prices have fallen. But
rents are important, though.
Well, they certainly are.
Yeah.
They certainly are. And in fact, that's one reason why people are so worried about inflation staying high next year, is that those rents are, the way they are calculated, they're going to spread out over several months.
Yeah, but we're aware of the lags in the calculation, and so we'll take that on board and take a look at that. But yeah, you're right. The core measure of PC inflation is still in the high fours, and the Dallas Fed trim mean 4.75 or so. So pretty high inflation in the U.S., even if you try to trim out some of the more volatile components. So we're going to have to get that turned around, moving in the right direction and back toward 2%.
So how are you going to do that? What does this mean for the restrictive terminal rate? The September SEP's medium target interest rate, 4.4% this year, 4.6% next year. After the latest data, what are your projections now?
Well, if you look at the September Summary of Economic Projections, the so-called dot plot, it did seem that the committee was coalescing around further rate increases at upcoming meetings, even by the end of the year. So that seems to be the base case right now. Most of that has been priced in the market, so I would anticipate that that's having an impact right now. So that's good news if you're trying to get inflation down. But we'll have to follow through on that in the subsequent meetings this year and get the policy rate up to a level where we can put meaningful downward pressure on inflation. I think that's the main goal immediately ahead of us at the committee.
So, off the cuff right now, what would you say that level looks like it's going to be? Is it going to be higher, for example, than you thought it might be? Is that the risk here? Not that you're going to be okay or you're going to move it lower, but they're actually going to need to have more rates to get to a more restrictive level.
Yeah, I've done this calculation about sort of a minimal level that you would have to get to put downward pressure on inflation. I did it at a conference in Stanford in May, and you can look it up on my webpage. But at that time, the number came out to 3.5%. But since then, the inflation news, unfortunately, has continued to surprise to the upside. So if you do that again now, you're going to get something closer to what's in the dot plot, 4.5, 4.75, something like that. And I think also, we're data dependent and we're watching the data. I think we're predicting, or at least the dot plot is predicting, that inflation will come down. It will be a disinflationary year in 2023.
St. Louis Fed President Jim Bullard in an exclusive interview there. Joining us now to further discuss is Bloomberg Markets editor Valerie Teitel. Valerie, did we get anything new from him there?
He's reiterating what we've heard from other Fed officials, that core inflation is the real enemy here. But I want to pick apart one thing he said, and it was at the end of his speech. He said market-based inflation expectations are looking good. I want to pick that apart. Break-evens since October, this entire month, have shifted higher across the curve. And then if we look at survey-based inflation metrics, the UMich data, for example, those ticked higher as well. And we know that the UMich survey explicitly follows gas prices. And we've seen things like the China reopening news, right? That has boosted oil prices this morning nearly 2% after closing 3% higher yesterday. I think there's a real risk that inflation expectations tick higher from here, and that will cause a ratcheting higher of the terminal rate.
All right, and well, U.S. yields hitting highs, cycle highs right now, as you showed an excellent chart earlier, Valerie. The BOJ, again, stepping in to defend their yield target. It's the same all over again, but what do we actually worry about, or why and when do we actually worry about a BOJ shift?
Look, we all know that this BOJ policy could break soon. We just don't know when. But I would put it in the bucket of things that could ruin your Thanksgiving, Matt. The market is very, very worried. And I want to show you something here on this chart. I've mapped out here the 10-year yen swap rate versus the bond yield. And we can see here with this red line, that's the 25 basis point yield curve control that the BOJ defends. The swap rate is trading at 61 basis points. That means those hedgers in the market were getting so worried that a yield curve control break situation might come. They're willing to pay nearly 35 basis points above the BOJ's target to put it on. And look, you know, yes, dollar yen is showing some fireworks, but the real fireworks comes from when the Bank of Japan shifts on their yield curve control, and then the last true buyer of fixed income steps back, and the world is really flooded with higher term premium and yield surge everywhere.
Okay, and I know that this could have read across outside Japan, of course, Valerie. We heard from Jim O'Neill, formerly of Goldman Sachs, of course, who said pretty recently, if this is poorly handled, it could have a much bigger global consequence than the recent UK mess. So we will watch very carefully. Thank you very much to Bloomberg's Valerie Teitel for the update there on both the Fed and also the BOJ. And if you want to see Valerie's charts up close, then you can go to GTV Go. That is the function to use on the Bloomberg terminal. Coming up on this program, European leaders are gathering for a two-day summit on energy. How bleak or otherwise does the picture look for this winter? We're live from Brussels next. This is Bloomberg.
Our biggest cost base is purchasing parts and our staff. The overall energy cost is not negligible, but it will not endanger our business in the current situation.
Our founding father, Charles Rolls, said in 1900 that he foresees a great future for electric cars once charging is fixed and is available. And I think now we are here fulfilling his prophecy.
We are fighting for the #1 spot in terms of pure EV sales in Europe.
It's the very first time that you can acquire in the super luxury segment an electric car.
The cost of EVs is concerned. As we scale this technology, eventually cost will start to come down.
From my perspective, I think electric is only a transition, but hydrogen can really be a solution.
We need to protect the affordability for the middle classes to access clean, safe automobiles. This is fundamental. And of course, the energy inflation is not helping.
Europe in particular will be challenged in the next 2, maybe 3 years. And we're working on fixing that, especially Germany that's been dependent on gas coming from Russia.
The governments, they have understood that they cannot bet on only one solution. And especially now where we see, for instance, you know, with the energy crisis, for instance, in Europe, we would like to have hydrogen.
If we go and look a little bit longer, mid to long term, I think this may even be a catalyst to go quicker into renewables.
Some European auto executives, their global auto executives, speaking this week on Bloomberg Television about their ambitions and plans to compete with the likes of Tesla and how they intend to deal with the energy crisis that we see on the continent and in the UK. Let's get a look at what's ahead today. The Turkish central bank will likely deliver another cut, further cementing its outlier status among global central banks. And then U.S. data coming out today includes U.S. existing home sales, initial jobless claims, Conference Board leading index. So you'll get those signals on the economy to the markets and to the Fed. Blackstone, Philip Morris, and Snap will be among the companies posting results today. And interesting after Philip Morris brings its bid to Swedish Match up to almost $16 billion. And finally, European Union leaders gather in Brussels for a summit that is dominated by energy. and the war in Ukraine. The meeting comes after the head of the Commission, Ursula von der Leyen, unveiled a sweeping plan to bring down energy prices across the continent. Anna?
Now let's get to our European correspondent, Maria Tadeo, who is covering that summit, Matt, that you were just mentioning. Maria, there is a plan for action around energy, and energy and war are the very linked topics of conversation at this summit. Is there any political consensus around the plan, though?
Well, Anna, today, finally, we get to find out whether or not there's consensus. It is decision time. Remember, the criticism just a few weeks ago is that there were so many ideas floating in the European space that it was very difficult to get to an actual informed debate that could produce results because there just were too many options out there. We know now that the Commission has put out a point plan. They talk about the, very dynamic price cap. It's unclear exactly how that would work in the real market. They also talk about a circuit breaker that could potentially put an end to price spikes in the market, the joint purchases of gas, all of this coming together for leaders to debate. The reality is, however, in this meeting, which I'm being told so far we're very far from consensus. That is from a source that I talked to who says this is still a conversation between a growing number of countries that want to see a price cap and Germany. Germany continues to say they do not support this idea because they worry the implications of it, the signal that it would send to the market could compromise supply for the Germans right now. This is a story about securing supply, even if it is expensive. This is going to get tense today. I am being told, as I said, there is no consensus on this, but you know very well in Brussels, the night is young and 24 hours, well, a lot of things can change in the city.
Maria, just quickly, as we talk about contention on some of these issues, are they at least still unified in their support for Ukraine, or are we starting to see some wavering in that support?
Look, I think we'll have to keep a close eye on Viktor Orban, the Hungarian prime minister, always very outspoken, the problem child for some in the European Union, but also Italy. Overnight, there was a private conversation from Silvio Berlusconi, which has created a national scandal in the country. He flat out blames Ukraine essentially for pushing Vladimir Putin into this invasion. He says some of the content has been taken out of context, but this is now a very contentious debate in Italy. The problem, of course, is Mario Draghi is on his way out. This meeting could be his last. And then this is a government that is still in the making.
Okay, Maria, thanks very much. The Italian perspective there on what's going on in Ukraine. Maria Tadeo in Brussels. She'll keep us up to date with all of the conclusions on energy and the war in Ukraine. That is it for Early Edition. We will keep the coverage coming, though. This is Bloomberg.